Hello, everybody. I'm Andrew Boudry.
And I'm Ryan Cummings.
Welcome to Your Bread and Butter podcast. We're going to be talking about war is chaotic. Your portfolio shouldn't be.
The goal of today is to answer questions about how to invest in a wartime environment and learn more about how to do so safely and efficiently.
Stay tuned.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Hello, everybody. Welcome to today's episode of Your Bread and Butter podcast. Today, we're going to be talking about war is chaotic. Your portfolio shouldn't be.
We want to talk about the uncertainty, the volatility, and really a lot of the emotional side that comes with a war. Talk more about when it comes to investing, however, what impact does war have on the stock markets, on your portfolios, on the real estate market, all these different things you can invest in, and how do you manage that appropriately?
Our episode just prior to this is talking about where we're at and where we're going, which is in historical context. So what we're talking about today is not really financial advice. It's historical context and strategic thinking and seeing how history may repeat itself. It may not, but history does give us that lagging indicator of where things have been when it's been more similar.
That's the goal of today, is to understand how these sorts of markets behave and not try to predict the outcome, but rather stay disciplined and think long-term rather than making fear-based decisions.
That is so true. I mean, why do wars uniquely feel dangerous to investors? I mean, even compared to recessions and financial crises, and the United States, hey, you've been alive for the last 25 years. You've seen some, 26 years, you've seen some major stuff with the dot-com crash of the 2000s. Then we had the financial crisis, which it was a legitimate financial crisis, a systemic problem in our financial system. Then we had COVID, which was systemic, but mostly biological. And it ended up, we worked through it. The economy and everything can be very resilient, but we should understand the historical nature of what happens when there's a war going on.
Yeah, war often, it feels different because there's a humanitarian approach or a humanitarian, concern that comes with getting into any war. And so I think that side, the danger, the uncertainty can, cause people to be maybe more concerned than in some of those other financial events you just mentioned. But the caveat with how markets behave in times of war is there can often be a fall before or at the onset of a war, when there's a lot of uncertainty, when there's a lot of, unclearness on where things are going and people are a little nervous or even scared in some cases. Yeah. But as wars progress, markets don't often fall. We're going to look at some examples of that, in the coming slide, but there's more often than not either stable nature to the stock market or even a positive upward trending nature to the stock market the longer a war drags on.
Yeah, I mean, the initial thing that happens in a war is that it shocks. It shocks the economy.
Market hates uncertainty.
Market hates uncertainty. Oh, my goodness. And the role of uncertainty versus actual economic damage is what we're really talking about today. Because uncertainty can influence an investor as much as it can influence a corporation who's not sure whether their company is going to have to continue to pay tariffs or will they be able to actually continuing to exist in business. So uncertainty itself can actually cause a whole lot of problems. But the common investor belief is that if there's a war, the markets are going to crash. And that's not necessarily true.
I think, we hear that opinion all the time from clients, even non-clients, family, friends, etc. when there's something like this that happens, assuming the market is just going to tank along with it. But often, very few times does that actually happen. And the times that it does, there's often another driver behind why the market crashed. Maybe it's monetary tightening, maybe it's asset bubbles like the dot-com bubble of the early 2000s, banking crisis like in 08, 09, actual like a structural recession within the economy. Right. So even if you do try to point to maybe the few areas where the economy and the markets have declined alongside a war, there's a lot of times like these underlying factors.
Yeah, you have to be. We want you to be aware that we're not trying to minimize any of the human tragedy that's going on here. This is a factual thing to just give investors an understanding of what history records in these type of environments. It doesn't guarantee anything. It highlights the difference between human suffering and market mechanics.
Right.
And as we move forward, I just want to make sure that anybody that's out there listening and watching, that you understand something about the capital markets, both the stock and bond markets in the United States. This is the core of the United States of America. Capitalism is one of our spreading philosophies that we try to bring around the world. Hopefully it's not become a theology, but it is something that we do promote to the rest of the world as far as free trade and democracy and all of that, which is great. But the truth is that when you have a war, there is a human side to that, and we're not trying to ignore that. But the capital markets are everything to this country. We had an agricultural society growing cotton and wheat, and we sold all those things to countries going on ships and whatever. But our world has changed. Yes, we still grow food and we do all of that, but most of our world centers around the stock and bond markets. And because of that, it's something that our government, your government, will always try to protect to the best of their ability. So as we go through this, realize that really at the centerpiece of this, we have a society that supports all of this, and we have a government structure that supports all of this. So
Agreed. And here are some examples of how that stock and bond market have reacted in some of these different conflicts. We go back all the way to the 1960s, and every major conflict, you can see here on this slide, the performance of the S&P 500 12 months after the peak of each one of these conflicts. And so, that's, I think, some context is in order here.
Yeah.
Because when we say the peak of each of these conflicts, well, there likely has been a bit of a decline. Like we were just talking about, just a few moments ago. Wars often start with maybe a bit of a shock, a bit of a dip in the market. And so after a reactionary dip in the stock market, the stock market can often recover very quickly. And you can see the average of these, they're not all positive, but the average is about 15.3%. And even the ones that are negative, I actually want to call those out for a moment because I think they're very interesting. Just the point we were making a second ago is even though there are a few out here negative, the Russia-Ukraine conflict, well, we had rampant inflation. That was really more so the results of that negative number you see on this slide, not the Russia-Ukraine conflict itself. The 2001, September 11th, 2001, the terrorist attacks that happened that year.
Yep.
We were looking at the dot-com bubble, being in the midst of a dot-com bubble that was likely causing, that decline and not the terrorist attacks themselves in the beginning of the war. And then even the Yom Kippur War in the 70s, we were in the midst of stagflation.
Absolutely.
Like we were just talking about in our last episode.
Yep.
These were the causes of those numbers being negative, not the actual conflicts themselves. So that goes to our point of, we see more positives than negatives, and even the negatives that we do see were not directly caused by these wars or these conflicts.
And again, there's no guarantees about any of these outcomes, but history does repeat itself. And so we have to be cautious as we move forward. So here's some core principles to think about your portfolio strategy in wartime. Number one, core principles: diversification across asset classes, geographies. In other words, you don't want to just stay United States. You also don't want to just stay international. You want to have an understanding of what geographies are going to get through this, what asset classes are going to get through this, and time horizons are very, very important to consider. Like, how long do you need that money to rest for? How long do you need it to grow for? When do you actually need it? There are time horizons they have to put in place.
There is, and we're going to actually, each one of these bullets we've got coming up on some next slides, we're going to dive more into them, but other things like avoiding panic selling. That's, I think, one of the most common detrimental mistakes that the average investor makes is when there's some kind of uncertainty, not just war, like we're talking about today, but even other declines in the market, recessionary activity or, pandemics or, you name it. The often reaction from the average investor is, well, I've just lost some money. I don't want to lose more. And let me pull out. that can be a huge detriment to your long-term wealth accumulation. So avoiding panicking, trying to also maintain some liquidity so you're not forced to sell, so you can hone in and stay true to those time horizons you were talking about. Because if you're investing some money for a 10-year time frame and something catastrophic happens financially, well, you don't want to be forced to liquidate those investments. So having liquidity is key to be able to be defensive when there's some economic volatility going on.
Yeah, and rebalancing your portfolio is a discipline, not a prediction, trying to predict where the market's going to go. It's about disciplining yourself and seeing how it works in the long run. And we have strategies. You got dollar cost averaging during volatility. And we'll go through these more, but focusing on a strong balance sheet for companies that you are going to be investing in, or manage your performance based on where they hold their holdings. And then stress testing your portfolio to see, well, could you handle emotionally these things, going up and down, just like the economist we talked about in the first episode we did on this, not liking the ups and the downs. But the truth is, you have to look at the stress testing financially as well as emotionally. What can you really handle?
You do, because if that stress test on the emotional side is going to cause you to ultimately panic sell, well, then that portfolio maybe needs to be adjusted, not just from a financial perspective, but from an emotional perspective too.
I mean, really truthfully, if you think about it, which biblical character would have been the greatest economist and stock market predictor ever?
Bible? I don't know.
It'd be Noah. Why? Because Noah kept all of his stock afloat while everybody else was in liquidation.
That's a good one.
It's Noah. All right. 2 extreme mistakes to avoid, like stay away, like it's a minefield.
Yes.
Number 1, panic
selling.
selling.
We already started to touch on it. Panic selling is one of the biggest mistakes. Why? Because it locks in losses. And often, especially with war, like we're discussing, you see steep declines at the onset of a war when there is that uncertainty. And locking in those losses will cause you to also miss any sharp recovery days. This is a statistic we always quote within investing in the markets of the 10 best days over in the stock market.
Of 10 or 20 years.
Right.
Thousands and thousands of dollars.
We're talking, 60% of the returns in a portfolio just by missing the 10 best days each year?
Well, we just had a recent day like this last week where the market went up, almost 3%. And if you weren't invested in the market because you were waiting for it to recover, well, you just missed out on that 3%.
Right.
So, you can't act emotionally. You have to have a system in place to make sure that you're managing your own emotional risk.
Right. Emotions and finances, they don't mix.
They had not a good mix.
And then the second mistake here is a little bit on the flip side, is trying to go all in on the war trades.
Oh, yeah.
Trying to take advantage of those specific sectors, the defense stocks, the energy stocks. We've seen some energy spikes even right now with the embargo on the Strait of Hormuz and oil prices rising. We've seen the energy sector have great numbers, not just oil too. The increased oil prices have caused other energy sources to also increase in cost and increase ultimately in value if you're an investor. So trying to go too all into those things can be tricky because, and we were talking about this just the other day, there are fluctuations, the volatility. They could be up one day, 1 week, a handful of weeks, and then before you know it, they've dropped overnight and you missed your chance to sell before you've able to capture all that value you might have accrued.
It's a simple reason why both of those fail. Number 1, fear always sells late. Greed buys late. And if there's one thing that Ryan and I talk about quite a bit, is that greed kills. People are always trying to get ahead of the game and try to predict this and predict that. And sometimes people are right. I get that. And they want to do it. That's fine. But the truth is, they often fail because of those 2 reasons.
Right.
So don't let fear run your life, because fear can also lead to greed. And greed also does not have a good, successful pattern in investing.
Correct. And so instead, if you want to try to take advantage of maybe some of these sectors and stick to that systematic method of investing, that's where rebalancing comes in. It allows you to forces you really, if you stick to it, to trim, what's run up. So if we see those little spikes in the energy sectors, you kind of trim off some of the profits from those to get your portfolio back in balance. You not let one sector throw your portfolio out of whack. And then add to maybe what has fallen, buy things that are of value, while at the same time, maintaining your base of diversification and your base of a good balanced mix across many different sectors.
So one of the philosophies that I've had, and I've seen it work over the years, is that it's not always where you were when the market falls that makes the difference. It's where you are when the market begins to rise. And if you're not in it, you don't get it. So if you're already out of the market, you've liquidated your stuff, you're not going to get any of the rise. But the truth is that if you've hired a good manager, depending on the portfolio that you've mixed, the manager's doing the exact thing that Ryan just said. They're trimming the areas where it's run up, maybe excessive value based on their research, or they've added to companies that have fallen in value and they're a great buy. So that's where a professional manager, now again, we don't make these decisions on any client's portfolio. We hire managers that do. So this is part of what we do, is finding the managers that are responsive during those time periods. But the truth is, you have to have somebody that's at the switch, that's doing it systematically, non-emotional.
Right. And these, this helps because this works in wartime, because we see lots of dispersion in different sectors.
Yes.
We see some sectors run up. We see some sectors take a beating. So this balances some of that dispersion out, and it takes a lot of that emotional, side of things off of the table.
Dispersion is a good word to use, actually, because war doesn't really have a necessary impact on just one little area. It is dispersed. So that's a really good word to use, and that's true. War does have a different effect on different things.
Right, and so this is, if you're going to use rebalancing as a tool, it's not a prediction tool. It's not a tool to try to get into that hot sector or avoid one area and buy in on another. It's a tool for maintenance. It's a systematic rule to live by, to be able to avoid the emotional and reactive mistakes.
One of the other points that you made, which I thought was really good, is that the price of a particular stock may move faster than its fundamentals for a lot of different reasons. So unless you are totally in the know, you're better off letting the system and the people that
even
are
then, if you're too much in the know, you might have some insider information,
and then you end up in jail. That's exactly where I was going with it, but I'm glad you got there. All right. The next one is your psychological truth.
Yep, and being able to, with that psychological truth, hold on to liquidity and make sure that you're not being left up at night on the what if, because if you tuned into our previous episode, we talked about a lot of different time periods some centered around war, some not, some centered around recession,
right,
and some not.
Right.
And some of the common themes in a lot of those different time periods were jobless numbers,
right,
higher unemployment, lower job creation, and in many times job losses. And if that were to happen to you, the last thing you want to do to derail your investment strategy, derail your diversification, derail your rebalancing, is have to cash out those investments, especially at a low, because you have a lack of liquidity. And so how do you get around that? Try to maintain liquidity at all times. It's part of a well-balanced financial plan. Have your properly funded emergency funds, cash reserves, maybe ideally in a high yield savings where you have your money earning a little something, a little bit of interest, not sitting there doing nothing in a standard bank account.
It's one of the things we talk about when our clients come in, is we talk about, so where do you see this year going? And what do you have for plans for finances over the next year? Just so we have a feeling for where they're at. And we had somebody come in and say, we were with somebody the other day, and they said, we're planning on when he retires, we're going to go to Ireland. Oh, that's awesome. That's great. When are you retiring? I don't know, 7-8 years from now. Okay. Well, I appreciate the pre-planning there. But when it comes to this, though, as far as timing goes, trying to time the bottom of the stock market is really a fool's game, because unless you know something that you shouldn't know, it's hard to know when the bottom is. That's really kind of like the issues here. People think that emotionally or they can figure out the bottom on something, and I've never been able to figure out the bottom on anything, but I do know that there's a strategy to handle that.
Yeah, but instead of, trying to just buy the bottom, like you said, having a little bit of liquidity can allow you to maybe make some purchases.
Exactly right.
Where you think the bottom might be, or at multiple bottoms, if there were to be multiple bottoms.
I can always tell when we've really trained our clients well, when they come in and the market's down, they're like, hey, I got some extra money.
Right.
Where can I put it?
Right. But there's balance with that too, right? It's, you don't want to, you got $100,000 of extra money. Well, maybe let's throw 20 in and, let's see how the market does.
Depending on your circumstances.
Right.
Yes.
Don't want to go all in necessarily on one particular time. So, being able to stay disciplined with the dollar cost averaging that we talked about earlier, and having that liquidity can help you take advantage of those different moments.
Yeah.
And stay emotionally stable.
I use the word dollar cost averaging. So dollar cost averaging is just basically having a system in place where you're investing every week or month, every couple months, every 3 months, not just emotionally waiting, well, I think it's a good time. It is good to have a system in place where you're in your 401k that you put in money every week or bi-weekly from your paycheck is dollar cost averaging strategy. But it can also be, if you have that 100,000 concerned about, well, is really the market going to recover, whatever. Okay, fine. Take some of that liquidity, invest it, see how things go for you. If you can afford to do another and the market's still down, you want to invest some more, then you do it. But definitely avoid a couple things. Avoid forcing yourself to have to sell your assets to do this or do this or do this because you didn't plan on liquidity. And try to provide for yourself that emotional stability that says, you know what, I can wait. I don't really need to take action on this right now, and really gauge your emotions on it and give yourself the room and the flexibility to make the best decision. And if you have a financial advisor, which we hope you do, please contact your advisor. Have a conversation with them. Ask them, do you think this is too risky? Is this not risky enough? Is this something, ask for advice. That's what you have your financial advisor for.
The point there is give yourself options.
Yes.
Right? Don't force yourself into a corner. Be able to pivot and make decisions at different times rather than going all in. So as we kind of wrap up here today, to summarize, a lot of today's points, the point here isn't to minimize war. Wars are absolutely tragic, not good in really almost any situation. But markets, they're adaptive and they don't always react the way you think they're going to react at the onset of a war.
Yeah, in particular, the reason why we spent so much time in our previous episode talking about historical perspective, because that's the only indicators we have of where we've been and where we might be going. It helps reduce fear to understand the dynamics of what's going around the world, because we are in a global economy now. As much as there might be people that say, oh, we don't really need Italy, or we don't need Canada, or we don't need... No, we're a global world, and the global trade is booming right now because of changes that have been made, which is really good for everybody. But historical perspective helps reduce your emotional fears.
It does. And you want to ask yourself if your long-term goals, if they don't change, just because headlines do, you want to keep them, stay grounded, stay with your strategies. Don't adjust them just because of what's going on within the geopolitical world. Adjust them when things change in your world. And I think the question really to ask yourself is, if you weren't watching the news, would you change your portfolio today?
That's a great question to ask. That's a great question. And I always remember that some of the most profound advice that has ever been given by a wealthy person, Warren Buffett, is that strategy beats prediction. Now, he didn't say that. You did. But strategy does beat prediction.
It does.
That's Warren Buffett. He says, when there's a fire sale going on, go in and buy the fire. Buy the stuff that's on sale for good companies. Other people are running out of the building. You look for the good ones that are left over, the good companies that are still there. So when fear is driving the market, find out where you can be in the market safely for your own, purposes. But really, strategy beats prediction anytime, because that's going to be steady Eddie all the way. Hey, listen, we're really glad you joined us today. We hope that you watched the previous episode to understand what in the world we're talking about. But remember, live today for the tomorrow that's in your heart.
because you'll never have more time to invest for tomorrow than you do today.
Thank you for being with us.
Bread and butter.